Picture this: a bunch of Wall Street's brightest stars. Nobel Prize winners who've cracked the code on pricing risky bets. A former Fed bigwig who knows the ins and outs of the money machine, and a trader so sharp he could slice through market noise like butter. They team up to build a fund that's supposed to turn tiny market glitches into steady gold. For a while it works like a charm, raking in eye-popping returns that make even the savviest investors jealous. But then a far-off storm in Russia brews up, and suddenly their foolproof plan starts cracking. The fund doesn't just stumble. It nearly pulls the whole financial world into a black hole. And get this, the very folks meant to watch over the system step in to patch things up, leaving us all wondering if the game's rigged for the big players. Back in the early 90s, the world of finance was buzzing with big brains and bigger ideas. That's when long-term capital management, or LTCM for short, got its start. Picture it like this: a group of super smart folks deciding to pool their talents to outsmart the markets. At the helm was John Merriweather, a guy who'd made his name trading bonds at Salomon Brothers, one of the heavy hitters on Wall Street. He wasn't alone. He brought in heavyweights like Black Scholes and Robert Merton, two economists who'd won the Nobel Prize in October 1997 for figuring out how to price options, those fancy bets on whether stocks or bonds will go up or down. Throw in David Mullins, who'd been second in command at the Federal Reserve, and a crew of sharp traders like Eric Rosenfeld, Victor Hagani, Larry Hillerbrand, Greg Hawkins, William Krasker, Dick Leahy, James McEntee, and Robert Shustak, and you've got a dream team that sounded unbeatable. Now, what were they up to? Their big play was something called arbitrage. Think of arbitrage like spotting a deal at a flea market, buying something cheap in one spot and flipping it for more somewhere else, pocketing the difference without much risk. No one really invented it. It's as old as trading itself, going back to ancient merchants spotting price gaps between cities. But LTCM took it to the next level with bonds and other fixed income stuff, where the edges are razor thin. For example, they'd buy an older US Treasury bond that's a tad cheaper because it's not as easy to trade, and sell short a newer one that's pricier due to high demand. History showed these prices would eventually line up, so they'd cash in on the convergence. Or they'd play the spread between Italian bonds and German ones, betting Europe's economies were heading toward unity with the euro on the horizon. These weren't wild gambles. They were calculated moves based on data and math. Financial channel and hit that bell. You won't want to miss the next tale of how everyday folks and big shots alike navigate the wild ride of money and markets. At the heart of their toolkit was the Black Scholes formula, cooked up back in 1973 by Scholes, Merton, and Fisher-Black. It's basically a math recipe to figure out what an option, a right to buy or sell something at a set price, should cost. You plug in stuff like the current price of the stock, how much time's left until the option expires, the risk-free interest rate, like what you'd get from a safe treasury bond, and volatility, which is how much the price jumps around. The cool part? It's linked to the heat equation from physics, modeling how heat spreads out. Kinda funny, right? Like using a kitchen thermometer to predict a wildfire. Works great until the flames get out of hand. But here's the catch. The original formula assumes volatility stays steady, like a calm sea. They smirk with what's called a volatility smile, where extreme bets cost more than the model predicts. So folks have patched it up over the years, with tweaks for jumping volatility or other real-world messiness. Without those fixes, it's like a leaky umbrella in a downpour. Elegant, but not always reliable. Scholes and Merton knew this. Their Nobels celebrated the breakthrough, even if it needed ongoing tune-ups. At LTCM, it helped them price volatility bets, like selling insurance on calm markets. Easy money until the storm hit. By early 1998, LTCM was sitting on a mountain, $125 billion in assets. Back then, that was massive. The whole US economy was about $9 trillion, so imagine a fund holding assets worth over 1% of the nation's output. Today, we print that kind of cash for stuff like $125 billion in student loan forgiveness, or a $100 billion high-speed rail project that might never finish. But LTCM wasn't just big, it was leveraged to the gills, borrowing 25 times its own money to amp up those tiny edges. Off the books, their derivatives, fancy contracts betting on interest rates or currencies, totaled $1.25 trillion, about 2% of the world's market. They even had a slice in emerging spots like Russia, figuring governments don't default. Their models said risks were diversified, markets liquid, correlations low. Sounded solid. But leverage is like borrowing a friend's sports car, thrilling until you hit a pothole. And potholes were coming. First, the 1997 Asian financial crisis. Countries like Thailand and South Korea saw their currencies tank, markets freeze, and investors bolt. LTCM took some hits, but held firm, doubling down because the math said spreads would narrow. Then, Russia blew up. Let's break that down simple. After the Soviet Union fell, Russia was a mess. Huge debts from loans to prop up the ruble, oil prices crashing, their big export, and a fixed exchange rate that drained reserves like a leaky faucet. Government numbers? Often fudged. Deficits played down, growth hyped up to keep investors happy. Why didn't LTCM see it? Hubris mostly. Their models crunched historical data and spat out tiny odds of a default. After all, governments can print money, right? But on August 17, 1998, Russia froze payments on local bonds, devalued the ruble, and halted foreign debt reps. Boom. Investors panicked, fleeing to safe havens like US Treasuries. Risky assets tanked together. Correlations that models said were low spiked to 1. August was brutal for LTCM. They lost $1.8 billion, wiping out 44% of their value in a month. One day alone, August 21st, torched $550 million. Leverage ballooned to 50 to 1, then effective leverage hit 250 to 1 as positions soured. Banks that once lent freely now demanded more collateral, squeezing them dry. Selling? Tough in a panic. Markets dried up, turning their book into quicksand. Rumors flew. If LTCM dumped everything, it'd crash prices further, hitting everyone. One trader likened it to yelling fire in a crowded theater while holding the door shut. Here's a lighter beat. Almost a year before LTCM imploded, Scholes and Merton's Nobel was announced in October 1997, like the universe chuckling at their model's limits. Another, Warren Buffett sniffed around, offering $250 million for the partner's stake, plus $3.75 billion to run it via Goldman Sachs. Gave Merriweather 60 minutes to decide. Tick-tock, no deal. Buffett's maverick style, cool, calculated, always sniffing folly. The Fed, that libertarian bogeyman of bureaucracy, saw the cliff edge. No one wanted a repeat of history's meltdowns. On September 23rd, New York Fed President William McDonough hauled in 14 banks to their HQ. The pitch: pony up $3.625 billion for 90% ownership. Keep LTCM afloat for an orderly unwind. No taxpayer dough, just private cash to dodge disaster. Why? Alan Greenspan later told Congress it was the scariest crisis in 50 years. LTCM's flop could freeze credit, slam fragile economies worldwide. 2 banks said no, Bear Stearns and Crédit Agricole, but the rest bit. $300 million apiece from most, less from others. It worked, sorta. Under new bosses, LTCM sold assets steadily, repaid the rescuers by 1999 with a profit, and folded in 2000. Partners? Their $4.7 billion fund shriveled to scraps, $250 million at Buffett's lowball point. The fallout? Ouch. In Russia, the ruble plunged 75%. Inflation hit 84%. GDP sank 5.3%. Banks busted. Oligarchs grabbed more power. Foreign cash fled, jacking up borrowing costs for years. As a footnote, that chaos eroded President Boris Yeltsin's hold, paving the way for Vladimir Putin's rise in 1999, turning economic rubble into a new era of strongman rule. Rubles hit Latin America. Brazil devalued its currency in 1999. Argentina's 2001 crash sparked riots, bank runs, and 5 presidents in weeks. Lol. That mess indirectly fueled the Kirchner's populist wave in 2003, railing against IMF austerity as the villain. No major US busts, but funds like D.E. Shaw and George Soros's Quantum nursed wounds. The Dow dipped 512 points on August 31st, but the bailout contained it. One bank, UBS, took a $663 million hit from exposure to LTCM, leading its chairman and 3 top executives to resign amid the fallout. For the players, Merriweather bounced back with JWM Partners in 1999, snagging Hagani, Hillebrand, Leahy, and Rosenfeld. Raised $250 million with tamer leverage, but echo of old hubris, it tanked 44% in 2008-99 and shuttered. He tried again with JM Advisors in 2010. Same playbook. Scholes settled a 2005 tax shelter flap tied to LTCM's offshore tricks. $40 million fine, no wrongdoing admitted. His next gig? Platinum Grove locked up redemptions in 2008 and folded in 2010. Merton retreated to academia at MIT and Harvard, advising on retirement funds. Mullins passed in 2018. Rosenfeld and Hillebrand scattered to new ventures, some flopping in later crises. They scraped by with remnants from the wreck, proving in finance, smarts fail, but networks endure. One casual aside, Merriweather's Salomon days, bogus treasury bids in 91 got him booted, yet he pivoted to LTCM stardom, Wall Street's ultimate comeback kid. Another, LTCM sold volatility in 97, scooping premiums like free candy. Crash hit, payouts stung, like insuring against quakes in shaky California. The 1999 report from the President's Working Group urged better counterparty checks, watching who you're lending to, and more hedge fund transparency. Lol, we know how that panned out. Fast forward to 2008's subprime nightmare. Leverage shadows, snapped correlations, vanished liquidity. Lehman got no lifeline. World paid. Libertarians grumble at crony rescues shielding elites, while everyday folks foot the bill. Official spin, LTCM was too interconnected to fail. Skeptics saw favoritism for the club. Yet LTCM wasn't just a flop. It laid bare how borrowed bucks and overconfidence fragilized the system. Emerging markets carried scars. Russia's woes arguably eased Putin's path. Banks swore by stress tests, till forgetting again. Players mostly rebounded, affirming finance forgives the connected. One more beat. UBS coughed up $663 million on put options gone sour post-bailout. Their chairman quit. Another. Greenspan called it his worst crisis in half a century, yet cut rates to juice recovery, planting seeds for the next bubble. The LTCM tale,